invests in low-risk, short-term debt securities, such as treasury bills, municipal debt, or corporate bonds. They're designed to offer a safe, stable investment option for money you may need to access in the short term, like an emergency fund or a short-term goal. Money market funds are different from money market accounts in a few important respects. While both offer low-risk ways to save money and earn modest returns, money market accounts are typically offered by banks and credit unions, and as deposit accounts, they're insured by the FDIC, the federal agency that insures bank deposits in the U.S. Money market funds are an investment product, so you need a brokerage account to get started. They can be a valuable tool for diversifying your portfolio, allowing you to earn interest on your savings while helping reduce market risk. Money market funds invest in low-risk assets like treasury bonds, CDs, or short-term, high-quality corporate bonds with maturities of less than a year. Unlike stock or bond funds, they have a fixed price of $1 per share, and money market funds aim to maintain their net asset value, NAV. That means your account value shouldn't change other than any growth from your earnings. While all money market funds have the same share price, their yields vary. To see what a money market fund is currently paying, look at the 7-day yield. This calculation is used to measure a fund's annualized yield. It gives you an idea of the return you can expect over the next year, based on the average payouts made in a week. This makes it helpful for comparing different money market funds. Taxable money market funds, also known as prime money market funds, usually offer higher yields than tax-exempt funds, but any income is subject to taxes. Prime funds invest in corporate and bank debt issued by U.S. and international entities. Tax-exempt funds, commonly called municipal funds, usually don't pay as much, but their earnings are federally tax-free, so they can be a better option for investors in a high-tax bracket. Some tax-exempt funds invest only in bonds issued by a specific state, which makes them both federal and state tax-free for residents of that state. Government money market funds invest only in assets backed by the federal government, for example, treasury bonds. Because of this government backing, they're considered the safest and most liquid type of money market fund. They often include the words government fund, treasury fund, or federal fund in their name. Retail funds can invest in other types of assets, like municipal bonds or short-term, high-quality corporate bonds. They're sometimes called prime funds. In addition, retail funds are required to follow SEC rules about liquidity fees and gates during times of extreme market stress. Point 4 These rules can mean you'd have to pay a fee or could be temporarily unable to withdraw money if a lot of investors sell shares at the same time. Government funds are allowed to follow these rules but aren't required to. Pros and cons of money market funds. Money market funds are meant to be safe. They're intended not to lose value. Liquid. You can withdraw your cash at any time without penalties. Higher yielding than savings at traditional banks. However, depending on what's important to you, you'll need to keep these points in mind. Insurance coverage. Traditional bank savings accounts and CDs are FDIC insured up to $250,000. Money market funds aren't insured by the FDIC. Instead, they may be eligible for $500,000 coverage under SIPC when held in a brokerage account. Accessibility. Because they're mutual funds, money market fund sales are processed like sales of other mutual funds. The trade is processed at the close of business following your trade request, and the money then takes 2 business days to transfer to your bank account. Bottom line, you'll need to allow time for money movement. Money market funds are a type of mutual fund that invest in liquid, short-term debt securities, cash, and cash equivalents. Money market funds have relatively low risks compared to other mutual funds and most other investments, but historically have had lower returns. Money market funds generally fall into 3 categories: government money market funds, tax-exempt money market funds, also called municipal money market funds, and prime money market funds. Money market funds are generally structured to cater to different types of investors. Some funds are intended for retail investors and are generally limited to individual human beings. Other money market funds, which typically require high minimum investments, are intended for institutional investors. Important: the rules governing money market funds vary based on the type of money market fund. Before buying shares of a money market fund, you should understand which type of money market fund you are purchasing. Why do people buy money market funds? Many investors use money market funds to store cash or as an alternative to bank savings vehicles. How do I earn money from money market funds? Money market funds pay dividends that generally reflect short-term interest rates. Many shareholders reinvest the dividends into the money market fund. Money market funds have historically had lower returns than other mutual funds. How do I buy and sell money market funds? Like all mutual funds, investors buy and sell money market fund shares from to the fund itself or through a broker for the fund, rather than from other investors on a national securities market. Also, like all mutual funds, money market funds are redeemable on demand. This means that investors can generally sell their shares back to a money market fund on any business day at the net asset value, NAV, per share. The NAV per share is the per share value of a fund's assets minus its liabilities. Stable NAV. Most money market funds, including money market funds intended for retail investors and government money market funds, seek to keep their NAV at a stable $1 per share. This means investors can generally buy and sell shares of these types of money market funds for $1. Floating NAV. Institutional prime and institutional tax-exempt money market funds must float their NAV like other mutual funds to reflect changes in the current market-based value of fund assets. This means that, although these money market funds still try to keep a fairly constant price, investors may buy or sell shares of these types of money market funds for more or less than $1 per share. How do I pay for my money market fund? As with any business, running a money market fund involves costs. Funds pass along these costs to investors by charging fees. Fees vary from fund to fund. What are the risks of investing in money market funds? For all money market funds, historically, the returns for money market funds have been lower than for other types of mutual funds. Because the yield for money market funds can be low, there is a risk that inflation will outpace and erode investment returns over time. Moreover, if short-term interest rates are very low, it is possible that fees charged by the fund will exceed the income earned on fund investments, in which case fund investors may face losses. As with any investment, you should consider the impact of fees on your investment. In addition, money invested in a money market fund is not guaranteed by the FDIC like bank accounts are. There is therefore a risk you may lose some or all of the money you invested. For stable NAV money market funds, if a stable NAV money market fund's NAV per share deviates by more than half a cent from $1, the fund must reprice its shares to something other than $1. This is known as breaking the buck and could happen when a money market fund is exposed to substantial losses from some of its holdings. If this happens during times of general turbulence in the financial markets, it could lead to a run on some money market funds. Although funds very rarely break the buck, if one does, the investor's holding in the fund would lose value. For floating NAV money market funds, as with other mutual fund investments, the value of floating NAV money market fund shares generally decreases or increases as the money market fund assets decrease or increase in value, respectively. If the value of the fund shares decrease, the investor's holding in the fund would lose value. What should I consider before investing in money market funds? Before investing in a mutual fund, you should carefully read the fund's available information, including its prospectus and most recent shareholder report. Consider whether the fund fits into your overall financial situation. Ask questions about anything you don't understand. You are entrusting your money to someone else. You should know where your money is going, who is managing it, how it is being invested, and how you can get it back. Effective cash management is critical for any organization. Holding the right amount of cash, in the right types of vehicles, can have a major impact on an organization's ability to meet its responsibilities and goals. Organizations can hold their cash in a variety of vehicles. Each option offers a different combination of key characteristics, including safety, preservation of your principal value; liquidity, the ability to withdraw your cash on demand; potential return, interest income the vehicle generates. Money market funds are among the most common and useful tools for managing cash holdings. Any professional who may be asked to weigh in on decisions related to cash management can benefit from a basic understanding of money market funds: what they are, how they work, and how they compare to other options. A money market fund is a mutual fund that invests in cash-equivalent short-term high-quality debt instruments. Money market funds have a key feature that distinguishes them from other cash options: most use amortized cost accounting, which enables them to maintain a consistent net asset value, NAV, of 1.00 per share in nearly all circumstances. To pursue that goal, they invest in very short-term debt, safety and liquidity as the primary objective. Depending on the specific fund, eligible investments may include government/sovereign treasuries, debt securities issued and guaranteed by their respective government; government agency debt securities issued by government agencies like the U.S.-based Federal Home Loan Bank; corporate or financial institution debt securities such as commercial paper, certificates of deposit, medium-term notes, or other unsecured debt issued by some of the largest corporations and banks; repurchase agreements, a form of short-term lending in which an investor agrees to loan money in exchange for collateral in excess of the loan. Most repurchase agreements are short-term loans with maturities of 1 day to 1 week. There are different types of money market funds, differentiated by the kinds of assets they are allowed to hold. Common rules governing money market funds. There are many rules that govern money market funds in both Europe and the US that limit risk and increase the safety of the vehicle. Besides the rules on the investment strategies listed above, the two major rules have to do with duration and liquidity. There are limits to duration on the portfolio and the specific investments, and there are minimum levels of liquidity that must be held by the fund. Each fund is subject to 3 duration limitations. Please reference the glossary of terms for specific definitions. Weighted average maturity is limited to 60 days. This is a measure of sensitivity to changes in interest rates. Weighted average life is limited to 120 days. This is a measure of credit sensitivity in the portfolio. Legal final maturity of a security is limited to 397 days except with specific government debt. Each fund must hold certain levels of liquidity. Liquidity in a money market fund is defined as the percent of a fund that matures in 1 business day, daily, and 5 business days, weekly, or meets specific security criteria, government agency or sovereign debt, based the domicile of the fund. U.S. funds must hold at least 25% in daily and 50% in weekly liquidity, and European funds must hold 10% and 30% respectively. There are many additional rules that govern money market funds, as well as specific rules that NRSRO rating agencies apply to money market funds. For a more detailed discussion on these rules, please reach out to your State Street representative. Fund types differ in their levels of risk, potential return, and tax efficiency. Be sure to request official fund documents such as a fact sheet and prospectus whenever researching and/or choosing investment options. The primary appeal of a money market fund lies in its combination of cash-like liquidity and stability with the potential to generate a market rate of return. A money fund's stability and liquidity may be essential for an organization to perform certain critical functions, such as meeting payroll, paying operating expenses, making debt payments, and funding capital expenditures. For a large organization managing substantial volumes of cash, the potential to earn market returns from a diversified portfolio of investments may generate revenues that help strengthen the organization. For these reasons, money market funds may complement bank deposit accounts. Deposits are stable and can be liquid but expose you to a single bank and may not pay a competitive return. The rate a bank deposit pays is determined by the specific bank and can change at any time without notice. A possible disadvantage of a money market fund is the management fee it charges. The fee is disclosed in the fund's prospectus, and typically in other fund materials as well. One should consult fund documents to know exactly what you are paying for your investment. Additionally, one should understand who the investment manager is, how committed to the business they are, and what their history has been managing money market funds. There are many attributes that can be looked at to evaluate a money market fund. Some of those include the following. The size of the fund matters, but the cash flows in the fund matter more. The money fund industry has consolidated over the past 30 years. There are now fewer providers and their funds are very large. When choosing a fund, it is important to look at the size of the fund and also the cash flows, or shareholder activity. You want to ensure that it is not gaining or losing a significant portion of its assets on a frequent basis. Additionally, some investors will limit their investment to no more than 10% of the fund's assets. Many funds will have a rating agency rate their funds. Moody's, S&P or Fitch are the most common, and they will provide a AAA rating. This rating will come with additional rules and oversight to what has already been established by the local regulator. The history and commitment of the asset manager to the cash business is also an important criteria when evaluating funds. One needs to ensure that the investment advisor is committed to the business and investing in the business. The advisor should have a long history of managing funds with a stellar track record of prioritizing the safety and liquidity of your investments. There are risks to all forms of investing, even in money market funds. One should always perform thorough due diligence before investing. A money market fund, also called a money market mutual fund, is an open-end mutual fund that invests in short-term debt securities such as U.S. Treasury bills and commercial paper. Money market funds are managed with the goal of maintaining a highly stable asset value through liquid investments, while paying income to investors in the form of dividends. Although they are not insured against loss, actual losses have been quite rare in practice. Regulated in the United States under the Investment Company Act of 1940, and in Europe under Regulation 2017/1131, money market funds are important providers of liquidity to financial intermediaries. Explanation: money market funds seek to limit exposure to losses due to credit, market, and liquidity risks. Money market funds in the United States are regulated by the Securities and Exchange Commission, SEC, under the Investment Company Act of 1940. Rule 2A7 of the Act restricts the quality, maturity, and diversity of investments by money market funds. Under this Act, a money fund mainly buys the highest rated debt, which matures in under 13 months. The portfolio must maintain a weighted average maturity, WAM, of 60 days or less and not invest more than 5% in any one issuer, except for government securities and repurchase agreements. Securities in which money markets may invest include commercial paper, repurchase agreements, short-term bonds, and other money funds. Money market securities must be highly liquid and of the highest quality. Thank you for watching this video.